Assalamu alaikum and a very good afternoon to all of you. Thank you for joining our webinar today. The topic of webinar is IFRS 16. Everyone knows IFRS 16 is applicable since 2019 January, and we have been implementing it to various clients of ours. Why we thought to come up with this webinar was basically we observed various challenges the client is facing during the implementation phases on some misconceptions or some terminologies, some guidance that the standard has given already, but the practical situations and the scenarios are quite different. So during our implementation phases, we come across various challenges that the clients are facing. We thought to jot them down together and discuss with you. We have our experts with us who can shed some light and the insights based on their practical experience. Let me start by introducing ourselves. I'm Khushboo Mushtaq, the Director of Advisory at athGADLANG, and I have with me two fine gentlemen of my team, Imad Uddin. We call Imad internally in our firm as a geek of IFRS. Imad comes with an experience of around 10 years, and he has been leading the projects of highly complex IFRS transactions for various industries in the region for our clients. We have requested him to come up and he can share his expertise and experiences with us today. On the other hand, we have Talha Ahmad. Talha is the Director of ERP and Business Transformation. Talha comes with an experience of more than 15 years. He is from a chartered accountancy background and his experience is very versatile. He has worked and implemented various systems. He is from Deloitte and we call him a perfect combo who not only understand the accounting part, the accounting technicalities, what IFRS says, but he also can translate everything into the system. So Talha will be talking a bit about how we can automate those digital tools for IFRS 16, and he can help you to improve efficiency, accuracy, and compliances in the lease accounting. So I will be the moderator of the session. Imad will be talking about what constitute a lease. He will help you understand the lease terms, the non-cancellable periods, extension, termination options, lease modifications. As we have come across COVID and IBOR reforms, we have seen various lease modifications in our agreements. So he can shed some light on those as well. And whatever happens, if their contracts are modified to some extent, how can that impact your leases? Talha will be talking about how to automate the lease accounting. He will share his practical experience and he will also give insight on the key challenges in the system. Without further ado, I would like to and request Imad to start the session. And we have, Alhamdulillah, a good number of attendees as well. So hopefully this session will be very insightful, all of you. And thank you again for joining. Imad, let's begin.
Thank you very much, Khushboo, for the introduction. As Khushboo said, there are a lot of issues and challenges in practice that people really don't understand. So the way we chose these topics today were meant to address those concerns, which are very frequent. But when we will discuss them, you might say, "Oh, why didn't I know that?" So there are a lot of things that are very common issues, and still they're not answered because as accountants, we have been more focused on how to calculate things, how to calculate lease, finance leases. We are most focused on, like I say, an average accountant might have discussed 100 times what is a finance lease and what is an operating lease. But there are a lot of issues, a lot of technical issues, which like what constitutes a lease term, what constitutes a lease. Maybe the rental agreement is not a lease. Maybe the rental agreement for 5 years does not have a lease term of 5 years. Or maybe a rental agreement for 1 year does not have a lease term of 1 year. So these are all these things we have to read between the lines. And these are very practical issues. So we really wanted to make this webinar fresh and new. So you can have new insights from this webinar that are very, very practical and very useful. All right. Identifying a lease. First of all, we all need to know that not all rental agreements are lease agreements. So when we talk about it, where for an arrangement to be leased, there should be an identified asset and right to control, which means if I'm talking about what is the item that is being leased and whether I'm able to control it as a lessee. So if an asset is not identified, the contract does not contain a lease very clearly. But also, if there's not a right to control that asset, the asset does not constitute a lease. Now, we will go further into various aspects of what makes an asset identified and what gives a lessee the right to control. So, for example, if customer obtains substantially all of the economic benefits, in that case, the customer would have the right to control. Similarly, customer has the right to direct the use, which is very important. We'll talk further about it with examples. So we'll go through examples basically one by one to see what scenarios might result in an asset not being identified or a lessee not having control. So for an arrangement to have an identified asset, the asset should be physically distinct and the supplier should not have the substitution right. So let's say we're talking about the bandwidth of internet or optical fibers. Let's say you're about to lease 70% of the capacity of the optical fiber. So is that 70% capacity distinct from the remaining 30% capacity? And this is the question we're going to delve into. Similarly, the supplier does not have the substitution right, which means if I lease a truck, can the person who gave me that truck substitute that truck for some other truck without asking me, without any prior predetermined agreement? And if that is the case, then maybe that substitution right means that I do not have that particular control over that particular asset, and that asset is not identified even. So here's a simple example. Imagine you want to open a new office in a different city for expanding your operations or expanding your capacity. You have recently rented 15 seats at a co-working space in Cairo for remote work. Now, the arrangement specifies that you have access to 15 seats, but the co-working space has the right to substitute the seats in rooms within the same building and floor within a 3-day notice, which means you do have the right to use those seats in a particular room. But if the co-working space wants, it can change the seats, change the room, and relocate you to any other room and seats. So my question would be, in that case, would it be considered an identified asset? So if you guys can, please feel free to share your comments and thoughts in the comments, especially if you can simply say yes or no about whether it's an identified asset or not. If it's an identified asset, you can simply type yes. If it's not, you can simply type no. All right. So as already explained, because there is a substitution right for those seats, we say that these we do not have an identified asset under this arrangement, right? Again, we are talking about two different things here. We have to have an identified asset and we have to have control. And in this particular case, the key consideration we were considering was whether there is an identified asset. And so the arrangement specifies 5 seats, but the seats and rooms may be substituted within the same building and floor. And therefore, there's no identified asset, and this 3-year contract does not constitute a lease, which means although it's more than 1 year, it's 3-year contract, you are renting seats for your office, still this particular contract is not a lease agreement. Here's in this scenario, your company rents a production plant for its 60% capacity during specific hours throughout the week. Remember, we just talked about optic fibers capacity. Here we are talking about the capacity of a production plant. So 60% of the capacity is rented out to us for, let's say, 3 or 4 or 5 years. The agreement details the hours when the plant is available for use, while the remaining 40% of the plant's capacity is used by another party. So we know we can use, for example, this particular producing plant for 60% of the hours in a day, and the remaining 40% are being used by some other party. Let's say we even know which hours they are. Let's say from 6 in the morning to 3 a.m. in the morning. Even if we know what hours those are, we still cannot say that there's a distinct identified asset, because that asset, because the right of use is for a particular capacity of an individual asset, which is shared with someone else as well. So we cannot yet say that there's a distinct identifiable asset. And so in this case, this is not going to be a lease agreement. This would not, and when we say an agreement is not going to be a lease agreement, we are saying that this contract is not covered in the IFRS 16. Again, the key consideration here was about whether this is an identified asset, and we have two evaluations here. First of all, the production plant is not physically distinct to your company, and your company does not have the right to substantially all the economic benefits from the use of the plant, as the other party also uses 40% of the capacity. So even if there was 60% capacity allocated to us, or let's say in case there was 95% capacity allocated to us, would that be a lease? We'll talk about it in a bit. Yeah. So let's say for the same plant, you have 95% capacity, you have rented out, and should this now be considered a lease? Well, the standard says because we have substantially all the economic benefits from this particular lease, we can say that this lease is a we have the asset is identified. Why? Because the production plant is almost entirely ours, and so we can distinctly identify that particular physical asset as being ours for a particular period of time. So although some negligible amount of capacity is used by someone else, because we are allowed to use the substantially all the economic benefit of that asset, we can say that there is a distinct asset, despite the fact that the capacity is indistinct in terms of a right of use. Okay, so initially, let me just remind you, we talked about whether a particular arrangement constitutes a lease has to do with two things. First is whether there is a right, there's an identified asset, and the other key concern is whether there's a right to control. Within the identified asset, we have covered all the examples, all the possible scenarios where an asset might not be identified for all the reasons. But even if the asset is identified, if there is no right to control that asset, the arrangement would still not constitute a lease. So to assess whether a contract conveys the right to control the use of an identified asset for a period of time, an entity shall assess whether customer has both. What? Firstly, the right to obtain substantially all the economic benefits from the use of an identified asset. Remember, this right to obtain substantially all of the economic benefits consideration was there also when we were considering whether the asset is identified. And it was there in a different context. We were considering, for example, when we have a particular capacity percentage allocated to us. In that case, if all of that economic benefits is ours, almost all of the assets economic benefit is ours. In that case, we can specify what asset is allocated to us, because we would assume that the entire distinct physical asset is ours. So that was a different context when we talked about obtaining substantially all the economic benefits. But when it comes to right to control, we are really seeing whether this particular asset is for us within the scope of that lease. We'll talk about it later. And the second is the right to direct the use of the identified asset. So if I can obtain substantially all the economic benefits, and I can direct the use of that identified asset, then I have the right to control. But what does it mean to have the right to direct the use? All right, here's a scenario. Under a rental arrangement, 25 trucks are rented for your company. However, the arrangement restricts the use of these trucks to within your city limits. So you have the right to use the trucks to your advantage, however you like, but you have to do it within your city. Maybe one can say that the capacity within a particular city is limited. And so if you drive them within your city, you might be able to avail them for 80% of the capacity. But if you're able to drive them out of the city, you might be able to avail them for 95% of their capacity. Maybe there's a restriction on the amount of economic benefits that is that's accruing to the lessee. However, we have to assess the benefits or economic benefits within the context of the contract. So within the context or within the limit of the contract, we have been given these assets within the city, and now we'll evaluate whether substantially all of the economic benefits within that city accrue to us from those assets. So in that case, yes, we can have all the benefits of those 25 trucks in that city, and therefore we have the right to direct the use of these assets. All right, the primary concern here is whether your company as a lessee has a right to control the trucks, as we just talked about. Under IFRS 16, this determination must be made within the scope of the rights transferred under the arrangement, as we just discussed. So first of all, we have talked about economic benefits. The context is within the city, and so we concluded that within the city, we can have all the economic benefits from those trucks. And directing the use, your company also has the right to direct the use of the trucks within the limits defined in the contract. So in this case, this contract would constitute a lease. So this was all about what is a lease, because this is so overlooked concept, because we almost always assume that this is such a simple thing that we don't even need to think about it. But in reality, there are a lot of things, a lot of peculiarities, a lot of nuances to this particular concept. And if, for example, something is not a lease, we do not have to employ IFRS 16 altogether. So scoping out is a very significant thing. And as we write accounting papers for our clients, we have to look at all of these tiny elements and look at whether a particular transaction is within the scope of certain thing or outside the scope, and what exemptions are there, and what exemptions within the exemptions are there. And so this is how, in reality, we have to, cover up or capture a particular transaction to comply with IFRS in general. And so, do we have any questions so far?
Yes, Imad, we did receive certain questions. I think all of them are linked to that 95% example. So one of the attendees would like to know what exactly constitutes substantial economic benefit.
Mm-hmm.
And the other would like to know what does that 95% makes a lease, and what if it is less than 100%? Should it not be a lease? One of them would like to know what if you don't have the right to direct the use of asset, and the 5% someone else is using, it is in his hands to decide the time of the day when he will use. So it's like quite confusing
All right,
question.
good. Really, really nice questions. It's really amazing.
Yes.
First of all, if you do
I
not
think
have the right to
it comes
direct,
from a practical example.
uh, okay. So if there is not a right to direct the use of the asset, then there is no lease at all. There cannot be any lease. But if there's a 5% that someone else is using, is the right of the other person whenever he uses. Even then, unless, for example, if you're running a plant and the other guy can come and disrupt your production and cause you economic loss, then maybe you're not being able to gain substantially all of the economic benefits. Maybe the loss is to the extent that you can only run it to your 80% capacity. In that case, you're not obtaining all of this substantially all of the economic benefits, and so you cannot take that whole asset as one, and therefore, in that case, there's no distinct identified asset. What are the lesser restriction that pertain to how the asset would be a lease contract? Basically, I think you're trying to ask how an asset would be used. Yeah, it's okay. Like there are a lot of arrangements where the lessor would not like his asset to be damaged. If an asset's useful life is 10 years and he is leasing it for 3 years, he may put across some reasonable restrictions to make sure that the asset is not damaged, the asset is not misused. All of those restrictions may be there to protect the asset and not to limit the economic benefits that the lessee can derive from those assets. In that case, still it can be an identified asset. It can still have the right to control. What
Thank you.
constitutes substantial economic benefits? Again, there's no quantitative threshold provided by the standard. I would say anything above 95% would easily be substantially all of the economic benefits. Anything less than 90% you would have to think about it. You might have to talk to it with your auditors in the context of that particular asset. So it's very judgmental. So you mean if less than 100% is rented, it should not be a lease in any case? No, I do not mean that. I'm saying if the asset is not identified, then it would not be the case. An example I gave for that was that if, for example, it's 60% leased uh, or 60% rented to you, in that case, the other 40% cannot be distinct from the 60% rented to you because it's a single asset, and so it would not constitute a lease. All right. Maybe we can move to the next section.
Yes, please. Thank you, attendees.
Thank you. Thank you very much for your participation and really asking the questions. I really appreciate it. Lease term. Okay, lease term is probably even more frequently misunderstood, more frequently challenging area. So let me ask you just a few simple questions that you would be able to answer by the end of this section. For example, if the lease agreement is renewable and renews every year, what would that be the case, right? In that case, what would the lease term be? Because in practice, we see some auditors accepting some longer lease terms than 1 year, some auditors accepting finance lease for these kind of contracts. Should we or should we not go for that treatment? If there are cancellation options in the agreement, how long is the lease term in that case? And if there are extension options. So we will see for each of these questions and many more with examples how to deal with various optionality and various nuances within the lease term. Okay, so what is appropriate treatment? What exactly is the lease term? So here's a definition and it has a lot of components. So we have to go one by one for all of these. Lease term is the non-cancellable period of the lease together with optional renewable periods that the lessee is reasonably certain to extend, and periods after optional termination date if the lessee is reasonably certain not to terminate the lease. So we're talking about a non-cancellable period. What that is, we'll talk about it. And then we have to also look at the options to renew and options to terminate the lease. So how do we look at all of these things? So when the lease starts, no, not when the lease starts, when there's the inception of the lease. Again, the lease commencement and lease inception are two different things. Lease inception is there when all the principal terms of the lease are agreed between the lessee and the lessor. So at the inception of the lease, we have to determine the non-cancellable period. Then we have to determine the enforceable period, which is something that is there in a lot of staff papers of IFRS, but not generally known or understood by the general audience. And then we have to determine the lease term. So we'll go step by step. We will first understand the non-cancellable period, then we'll understand the enforceable period, and then finally we'll go with all the options to see what exactly is the lease term for a particular contract. Now, the general understanding is that the non-cancellable period is the period during which lease cannot be cancelled or terminated. But by whom? Or under what conditions? So here's an example to just ease your knowledge. Your company enters into a lease agreement for 6 years. However, the agreement includes clauses that allow the lessor to cancel the lease after 3 years and the lessee to cancel the lease after 5 years. So here we are saying the lease agreement is for 6 years, but the lessor can cancel the lease after 3 years and the lessee can cancel the lease after 5 years. So in this particular example, what is the non-cancellable period? If you have any guesses, I would love to hear them in the chats. Is it 6 years, 5 years, or 3 years? Anyone willing to stick his neck out? Any guesses? 3 years. Any other guesses? 5 years. Sounds like there's a lot to learn today. There are a lot of complications here, but this is the simplest question that we had so far. So basically, in this case, the non-cancelable period is 5 years. So what we had to consider was non-cancelable period. This is the time after which it can be terminated. But the key that we need to note here is that we have to look at the lessee's perspective, whether the lessee can cancel it or not. If the lessee, the person who's obtaining that asset under the lease, is able to cancel it, that is the time when this becomes cancelable. Anytime before that, it's non-cancelable. So if you look at the previous example, we had a 6-year agreement, but the lessor could cancel it within 3 years, and lessee could cancel it after 5 years. So the non-cancelable period for this particular example is 5 years, not 3 years. All right, I think this was interesting, right? This is exactly what the purpose of this particular webinar, that we bring up fresh issues, new issues that people say, okay, I didn't know that. This is just such a common thing, right? So if there is a termination agreement, termination clause within a contract that only gives right to the lessor to terminate the lease, in that case, we would not consider that. The termination option is only relevant from the lessee's perspective. All right, we have talked about the non-cancelable period. Now let's talk about the enforceable period. This is slightly more complex than non-cancelable period, so you have to focus a little more. The enforceable period of a lease is the period for which enforceable rights and obligations exist between the lessee and the lessor. This is obviously common sense. The period during which the lease agreement is considered to be enforceable by the standard. But what is that period? A lease is no longer enforceable beyond the point at which both the lessee and the lessor have the unilateral right to terminate the lease without permission from the other party and with no more than an insignificant penalty. So if both the parties can terminate the lease and both the parties will not have to suffer any penalty, that is the period that is unenforceable. So any period before that particular condition arises, the contract is enforceable. And we would talk about its enforceability, especially in the context of renewable leases, when leases are renewed. So how to consider those situations. So here is another example. So this is what real learning looks like. When we talk about real learning, we have to look at the real world scenarios, real world like scenarios, and go into a lot of examples. And that's the purpose here in this webinar. So let's say lessee D leases a warehouse from lessor E under the following terms. The written contract is for a maximum term of 5 years. So the D is the lessee, E is the lessor, lease term is 5 years. After year 3, both D and E have the unilateral right to terminate the lease within the 3-month notice period. That is, the lease terminates 3 months after the termination notice is given. Notice cannot be given before the end of year 3. So what we are saying here is that after 3 years, both D and E can terminate the lease after giving a 3 months notice. However, this is a very important condition. Lessee will incur a penalty, which is significant, if it terminates the lease before the end of 4 years. which means although the lessee had the right to terminate the lease at the end of 3 years, lessee will still be required to incur a penalty until the end of 4 years, after which he can still cancel the lease and without any penalty. But lessor will not suffer a more than significant penalty in any case. So in this case, we have to look at what is the enforceable period and what is the non-cancellable period. So the definition of non-cancellable period is quite straightforward. The lessee should have the right to cancel it for it to be cancelable. And so any time before the lessee has the right to cancel the lease, it is non-cancellable. But the definition of enforceable period is slightly more complex because it involves the concept of penalty. But here we know very clear cut that the lessee will incur a penalty if it cancels before 4 years. So here's the analysis. We need to consider the period during which the contract is enforceable. So after 3 years, both the parties can terminate with the 3 months notice. And so the enforceable period is a time frame during which the lease is legally binding and enforceable by both parties, right? But the initial period is the 4 years during which both parties cannot terminate the lease without insignificant penalty, right? So that is the enforceable period. 4 years during which both the parties cannot terminate the lease without any penalty. So it's very straightforward. We have a 4-year enforceable period. But what would be the lease term in this particular case? Here's the graphical representation of it. So the enforceable period is 4 years and 3 months, and non-cancelable period is 3 years and 3 months. That's because we had to give a 3 months notice, and so we have to abide by the contract within the notice period as well. And so this is what the non-cancelable period and enforceable period looks like. Now, if, for example, the lessee was not expected or not reasonably certain to cancel the lease after the end of 3 years and 3 months, the lease term would have been longer, right? But the lease term can never be longer than the enforceable period. Now we're going somewhere. Make sense? So again, the non-cancelable period in this example is 3 years and 3 months, because after 3 years, the lessee can terminate a lease, giving a 3 months notice, and it has to abide by the contract during those 3 months notice period as well. So the lessee can cancel the contract after 3 years and 3 months. However, lessee will have to incur penalties until the end of 4 years and 3 months. And so we have a non-cancelable period of 3 years. Now, when we'll talk about extension options or cancellation options, so if the lessee is not reasonably certain to cancel the lease here, then the lease term might be longer than the non-cancelable period. But the lease term can never be longer than the enforceable period. Okay, now let's talk about options. Within the contract, there can be options. I think are we going too fast to absorb? I'm trying to repeat and make sure that everything just sits well into the mind.
Attendees, if you have any questions or if you want him to slow down, so please drop your comments. I don't see any comment. I think they're okay with the pace.
Right, great.
Okay. Thank you, Aslan.
Perfect. So let's talk about options. The lease term is the non-cancelable period of the lease together with optional renewable periods if the lessee is reasonably certain to extend, and periods after an optional termination date if the lessee is reasonably certain not to terminate. Now, there is a requirement of reasonable certainty in both the options for renewing and options for termination, but the direction of that reasonable certainty is exactly the opposite. We'll talk about it with example. All right. So let's say initial lease term for which the lessee has no option to terminate the lease is until here. Now, lessee has an option to extend the lease until here, right? But the lessee does not have, but the lessee is not reasonably certain to extend the lease until the point 3. Lessee is only reasonably certain to extend the lease until point 2, right? So so the lease term in this case would be until point 2, and because this extension option is within the enforceable period. So this extension options limit is within the enforceable period. On the contrary, when we talk about the termination option, let's say the employee had a termination option here instead of the extension option, then we would only consider the point up till here if the lessee was reasonably certain not to exercise that option, which means it was almost 100, we were almost 100% confident that the lessee would not exercise termination option. Only then the periods after the termination option would be included within the lease term. And so this is how both the options work. But again, the final objective is to know that the lessee, we are 100% confident that the lease would be until a particular period. Let's say we are 80% confident that there's not a reasonable certainty there, then we would have to reduce the lease term to any point until which we are reasonably certain. So again, when we talk about renewal options here, it's the same thing. So if you're reasonably certain that the contract would be renewed and that renewal periods also are included within the enforceable period, then we can have a longer period than the contractually agreed 1 year, 2 year, which is very practical and is a very common problem in practice.
Okay, Imad, I have a question regarding the lease term. I'm sure many of our attendees might have the same. So basically, in GCC, especially in UAE, if I would say, there are lease term or lease contracts for not more than 1 year. We have seen it on many of our clients, especially the retails. They have a contract for tenancy for not more than 1 year, but they are huge clients. They have a extensive market share. They are big brands, retail outlets. Of course, we assume that they are not going to change it every year. So in that case, and they have more than, let's say, 50 or 100 outlets all over the UAE and GCC, if I may say. In that case, what do you recommend for those clients, for those lease contracts? What should be the lease term? Will that be a lease? Because as per IFRS 16, if the contract is less than a year or a year, you can take it as an exception, right? You don't have to follow the entire IFRS 16 rules and take it as, let's say, an operating lease. In that case, what do you recommend?
Again, the basic concept is the same, that when we have multiple options to renew the lease, we'll have to look at whether it is reasonably certain to be renewed. So for example, if there's a 1 year contract, the one thing that we'll look at is whether it's reasonably certain to be renewed for, let's say, 3 years. Maybe we cannot look for further than 3 years from a plan's perspective, right? Maybe we cannot be reasonably certain after 5 years. So one thing that we need to look at is the reasonable certainty of that extension of a particular lease. And the second thing we need to look at is the enforceable period, which means whether if the lessee leaves that particular retail outlet, would it incur a significant penalty? Now, the most interesting thing is that in the staff paper, the board members say that this particular penalty is not just about whether you have to pay some cash to the lessor. Rather, it's also about whether you have some economic penalty by moving to a different location. So, for example, if you relocate to some other place, you might have to incur some capital expenditures over there. You might have to just make a lot of losses, a lot of losses, and a lot of expenses. So in that case, it becomes a little judgmental. But if there's that penalty, we can have an argument that the enforceable period is up to a particular point. In my view, the enforceable period would not be a problem because the penalty, because of broad definition of the penalty, it can always be justified. What would be difficult to justify would be the reasonable certainty of the extension. I hope
Okay,
this makes
very
sense.
well explained. I hope this helps. Yeah, I think one of the attendee has the same question. Great. Let's move on to the next section.
Perfect. Maybe we can have a breather if everyone's a little tired, because this is going to be a slightly more intensive lease modifications, right?
I think
Oh,
everyone is enjoying.
yeah. Maybe we can talk about
Can we
what.
take another question meanwhile?
I have a question for you, Khushboo. What you had in the breakfast today?
I just had a cup of coffee.
No way. Okay.
Yeah, I'll get one more.
I had boiled eggs, by the way.
I think Talha is being bored. Talha, how's
Uh,
it going with you?
No,
Are you learning some new tactics of IFRS 16?
I mean, I think this is very, very interesting in terms of understanding how IFRS 16 is working right now and the concept, the way Ahmad is explaining to everyone. I mean, this is very absorbing. And these are practical examples, like, I mean, you're not just reading through the book, you're actually understanding how the implementation works, basically. So I'm sure like everyone is having a really good time in terms of understanding how the IFRS 16 implementation is being done. And then specifically, once we talk about the UAE market or GCC market as well, I mean, example for the lease of the offices, this is something every accountant faces, wherever they are working as of now. So, I mean, I'm truly, grateful for the knowledge being shared by Imad. It's been, I'm sure, very, very helpful for everyone else as well.
Thank you, Talha, for the appreciative comments. I think this has been enough of a breather for everyone to just move on to lease modifications, right?
Imad, I think we have one more question related to the lease term, and it's
Sure,
actually
sure.
linked.
Mm-hmm.
So, someone would like to know if they assume a longer lease term based on the assumptions at the inception, like we discussed, 3 years or 5 years,
Mm-hmm.
and later on, as the time passes, the lease is actually not renewed for any
Mm.
reason. In that case, what happens?
This is
They have
exactly.
already created the liability for example, 3 years. They have already created the asset. They have planned for quarterly or monthly depreciation, interest recharge, lease payments going on, etc., etc. In that case, if for any reason the lease is not renewed, what happens?
This is exactly what we're going to discuss in the next slide, probably. And so this is really about reassessments, right? So
Okay.
the distinction need to be made whether what is a modification and what is a reassessment. Um, all right. So understanding lease modification. A lease modification is a change in the scope of a lease or the consideration for a lease that was not part of its original terms and conditions, right? Which means if the original terms and conditions of the contract have been changed, that is a modification. Anything else is a reassessment. And again, reassessment is a change in estimate, remember. So any reassessment, again, my plan was on the slide to give an example of reassessment, but the question is already provided, and there's a lease modification. So when we talk about reassessment, this is basically what estimates did we assume when we started accounting for the lease. For example, if there was an extension option and at that particular point, we were reasonably certain that the lease would be extended from 5 years to 8 years, and we assumed an 8-year period. But at the end of 5 years, we realized that our business is not working. We need to shut down. And so our assumption would have to change from 8 years to 5 years again. At the end of 5 years, for example. So this would be a change in estimate, and this would be accounted for accordingly. But but when we talk about changes in the lease arrangement itself, that is something that we have to look at slightly from the point of view of this particular standard, IFRS 16, not the simple reassessment or change in estimates. But I would also like to highlight that this is not the only two situations that could occur to you. For example, there could be an error as well. Maybe you had a particular lease agreement, you had certain assumptions, But despite that assumptions, you made an error in your estimates. For example, you assumed, for example, you took a wrong interest rate implicit in the lease or the incremental borrowing rate of interest. If that change has to be made, it will have to be made retrospectively. So we have seen all these situations at clients when we were helping them with different lease arrangements. There was a client who was confused whether this is a lease modification, whether it's a reassessment, or whether it's an error. And so it's important to have that distinction, because all of these three things would be accounted for differently, would have different accounting implications. The final statement would have different reporting and disclosure implications. All right. Let's look at the modifications from the point of view of the lessee, because lessors are slightly more complex, and we have few lessors in the world than lessees, because leasing companies and banks are limited to being lessor. The rest of us are just lessees, unless we are lessing out. Okay, increase in scope by adding the right of use asset at a standalone price, not at a standalone price. So there are two kinds of modifications that can happen, primarily increase in scope and decrease in scope, right? If the increase in scope is such that an asset is added to your agreement. For example, previously you were renting out, for example, 800 square feet. Now you're leasing 1,000 square feet, which means you have increased 25% of your asset. And if it's at a standalone price, then we would have to account that for that 200 additional square feet as a separate lease. So that's the one kind of modification where we have an increase in scope, and the scope is proportionate to the, and the lease payment increase is proportionate to the increase in the surface area or the amount of assets that has been added. So in that case, it would be accounted for as a separate lease. If this increase in scope is not at a standalone selling price, then we would have the remeasurement of lease liability. We increased, for example, the lease payment increased from 100 to 120. So we have to discount it again based on the new discount rate to come up with the new lease liability estimate. If, however, we have a decrease in scope, then it's almost like a partial termination. And in this case, in the previous case, if there was an increase in scope, any increase in lease liability would have resulted in an increase in the right of use asset. There would not have been any effect in the income statement for this particular increase in scope. But when we talk about decrease in scope, we are thinking of it as a partial termination, and there would be a gain on or loss on that particular modification. Any other modification, we treat like a increase in scope without that is not at a standalone price, which means a remeasurement liability on after modification. All right, so let's go through this slightly more slowly, one by one, point by point. A lessee accounts for a lease modification as a separate lease if both of the following conditions exist. So when do we account for modification as a separate lease? When the modification increases the scope and the consideration for the lease increase by the amount commensurate with the standalone price for the increase in scope, and any appropriate adjustment to the standalone price to reflect the circumstances of the particular contract. So essentially, we are saying we are leasing more things at more price, and the more price is proportional to the more things we are leasing. And so these more things would be treated as a separate lease altogether, rather than a modification in the same lease contract, even if in form is the same lease contract, but for accounting purposes, we would treat it as a separate lease. But what if it's not a separate lease? What if the increase in scope is not commensurate with the lease term? So we'll read through an example. If you have any question, please feel free to ask. I'll try to make it as clear as possible, but you'll have to, focus a little bit more into this. We have just two such examples, which are slightly more involving. Bear with us, and I think it would be really beneficial. So we have a lessee, which is X, and we have a lessor, which is Y. And the lessee X enters into a 20-year lease of a manufacturing plant with the lessor Y. So initial lease term is 20 years. The annual lease payments are 150,000 payable in areas. And the interest rate is, in this case, 5%. So these are simple terms. We have a 20-year lease between X and Y, 150,000 payments, 150,000 lease rental per year, and 5% is the discount rate. So the lease liability initially recognized was 1.869 million. So this was our initial scenario for this particular lease, but now we had a modification. So this was initially a 20-year lease, but after the end of 18 years, we decided that it should be a 30-year lease. So we extended the lease by 10 years. And so the lease term would now be 30 years. Now, now again, we are not leasing any additional asset here. We are only increasing the lease term, which means this cannot be treated as a separate lease. So what we have to do, we have to remeasure the lease liability. How do we measure the lease liability? Now we have to look at the updated discount rate, the new incremental borrowing rate of interest at the date of modification, which is 8% now. The annual lease payments per year is exactly the same, 150,000. When we discount 150,000 per annum by 8% for the next 12 years, we'll have a new lease liability, which is 1.13 million. However, if you look at this, we had at the time of modification, the carrying values were as follows. The lease liability was 278,000 and the right of use asset was 186,000. But now we want to remeasure lease liability to 1.13 million. So we have a difference of 851,000 in the lease liability, right? And this difference should increase both the lease liability and the right of use asset. So the right of use asset would be debited by 851,000 and lease liability would be credited by 851,000. So it's a very simple adjustment to both of these assets and liabilities in case of modification. And remember which case is this? This is the case where we are increasing the scope, and the scope increase is not separate asset and it's not a standalone price. So we have to remeasure it and have the same effect in the lease liability as well as the right of use asset. Now, what happens when there is a decrease in the scope? All right. Here we have two parties, lessee E and lessor F. In this case, we rented out 10,000 meters square of office space for 10 years. In this case, rentals are 100,000 and the discount rate is 7%. So the present value of the lease payments for these 10 years at a discount rate of 7% was 702,358 at the commencement. So this was our initial agreement, initial estimate of the lease liability. However, when we reached year 7, at the beginning of year 7, the two parties agreed to reduce the space to 7,500 meters square. So we are reducing the space from 10,000 meters square to 7,500 meters square, which is around 25% reduction in the space. The new discount rate is now 8%. And at the date of modification, the carrying value of right of use asset was 280,000 and lease liability is 338,000. Now, what do we do about this? Should we adjust the lease liability based on the new rental, the new discount rate? We will do that, but before that, we also have one more step. So what we are saying here really is that we have the right of use assets carrying value is 280,000. And we are now saying that 25% of this asset is lost now. We are leaving out this asset for 25%. So we will reduce the right of use asset carrying amount by 25%. And similarly, we are saying the lease liability should also be reduced practically by 25%. And so here is the treatment. So there are two steps. At step 1, as I said, we would proportionally reduce the pre-modification carrying values. So the right of use asset would be reduced by 70,000 and the lease liability would be reduced by 84,000. And because step one, we are not having the same amount adjust both the asset and liability, we are reducing each of those by 25%. Therefore, the decrease would never be the same, and there would be a resulting gain or loss. In this particular case, we are reducing the asset by 70%, 70,000, and reducing the liability by 84,000, which means we are reducing the liability more, and therefore we have a gain. And this is considered as a partial gain on termination. However, we need to have this liability. We need to have this liability at the amount which reflects the future lease payments and the updated discount rate. So that's what we would do now. So we would remeasure lease liability just as we did for a increase in the scope that was not a separate lease. And we come up with the present value of all the cash payments that are in the future. And so the amount was 248. Now, after reducing the liability by 84,000, we have 254,000, and now we have to bring it to 248. So any difference, which is 5,631, would be an adjustment to both the right of use asset as well as the lease liability. Now, step 2 is similar to the previous modification where we increase the scope without having a separate lease. But before that, we have to do step 1, which would result in a gain or loss in the income statement. So this was the treatment for lease modifications. And this is all from my side. If you have any questions, please feel free to know. Feel free to ask. Khushboo, would you like to discuss something?
Yes, Imad, we have few questions. Someone is asking if we can get a written manual. I think we will upload it on the YouTube channel, the entire webinar, and you can just revisit us and take the snippets of the areas you would like to understand in more detail. Otherwise, you can write us back if you need any clarification. We'll share the email ID and other contact details at the end.
Also,
Someone is
Khushboo, I'm
asking,
sorry,
yes.
I'm interrupting. Also, please, we would like to tell you that we are having a training session on IFRS 9 on 8th of August. It would be online. You can get it from anywhere. You can attend it from anywhere. It would be a full day session. It would cover classification, measurement, impairment, hedge accounting, all of these things that especially if you're in financial institutions, and even if you are in manufacturing companies, these are the areas where people already get confused very often. Like I'm the manager of FAS advisory. I often get clients asking me about IFRS 9 ECL requirements and their validation, review, all of these things. So if you want to learn more about IFRS 9, please make sure you attend that particular training session. I think I would also share the link of that session post after Mr. Talha starts talking. Would that be fine?
That will be great. Imad, we have one more question. It was okay. If there is an increase in the rental amount only after years, would it also come under the purview of lease modification?
If there's an increase in the rental amount only after
Few years, let's say second year, and the amount of the total lease changes. Will that be considered as a lease modification?
Yeah.
And
So this is something
what will be the treatment? If you can quickly just share your glimpse on the treatment, maybe some accounting entries.
Sure. And the question is about increasing the lease payments?
Yes, someone would like to know if there is a lease modification in the rental, what is the treatment?
All right. So first of all, if the rental increases, it could either be without modification as well. So for example, if there were variable lease payments within the contract, then if we have changed the estimates of what those payments would be in the future, then too we can have a different view of the lease liability, and that would be a reassessment. Similarly, we had a lot of such questions during the COVID when there were a lot of rent concessions. So for example, if your lease agreement already had some clause of contingency within the agreement that if something bad happens or some decline happens within the economy or something like that, or in sales, the lease rental would reduce to a certain extent, then that too would be a reassessment because those terms were already in the contract and nothing had been modified. But if really the contract has been modified and the lease has increased, this would, even after 2 or 3 years, doesn't matter. when the contract has changed. If there is a change in the lease payments, then it would have to be accounted for accordingly, which means the lease liability would be remeasured to the new amount, which would be based on the updated discount rate and based on the future expected lease payments under the contract.
And where would we take if there is any difference from the previous one?
So the any increase in lease liability would be credited in lease liability and debited in the right of use asset. So both would be adjusted.
I hope, Omer, you got the answer. Someone is asking us the link for IFRS 9 session. Yes, we will share shortly. Okay. If the lease contract gets onerous, so the penalty amount to the end of the contract, will it be used? Very tricky question.
Penalty
Nice.
amount would be used for
Yeah,
determining the
maybe.
onerous. First of all,
So the
first of all,
penalty.
yeah.
Yeah, please continue.
Yeah, so when we talk about onerous contracts, it's about how much we are earning from it and how much we are spending on it. So, for example, what I can think of how a lease agreement can be onerous is if the lease agreement was meant to sublease that particular asset. So, I'm renting a particular asset or a plant or a factory or a truck from one particular entity and subleasing it to other entity. And now I see that the rentals that I'm receiving are going to be lower than the rentals I'm about to pay. In that case, I can think that that particular contract has become onerous. And when we are determining what contract, when we're determining whether the contract has become onerous, we'll have to look at all the expected payments under both the contracts.
Okay, I hope the question is answered. Someone would like to know if the rental amount is increased, do we need to change the interest rate?
The interest rate is not dependent on the rental amount. Interest rate normally used by lessees is the incremental borrowing rate of interest, and it is determined at the date when the modification happens. So just like market rates keep increasing, and what is exactly the incremental borrowing rate? So if I go to bank today and try to rent or try to loan out a particular amount to buy that kind of assets, what interest rate would I be charged? What borrowing cost would I be charged? That's the incremental borrowing rate of interest. Given my current circumstances, given my current debt equity ratio, given my current leverage, given my current liabilities. So having all of that, what would be my my cost of borrowing given my current circumstances, cost of additional borrowing given my current circumstances. So that would always keep changing, and whenever there's a modification, we would have to take the amount, take the discount rate after that particular at the date of modification.
Lovely. Someone is appreciating the Q&As.
Thank you.
He's saying that it looks like I'm in a class. Well, I hope it is a good, appreciative message.
Yeah, and I hope it's slightly deeper than a class. I hope slightly more practical.
Yes. Yeah, because that's what we agreed. We wanted to share the practical insight. And good that we are getting some questions that are directly coming from finance individuals who are sitting in different companies and their personal experiences. Another good one, which is very basic, but I would like to share it across. So, talking about the ROU asset and the lease liability schedules, when there is a modification, the schedule will be changed from initial date or new schedule will be prepared from the date there is a modification for the remaining period of the lease.
Indeed, when a modification happens, we're only looking at the future, not looking at the past. So the entire schedule can be remade without looking at what happened in the past, and you will still have the same calculations.
I think this question is also answered, whether the reassessment and modification will have a prospective impact, which he just answered.
It will have a prospective impact, will not have a retrospective impact. Both these things.
Okay, someone, Omer, I think you can get this answer once you will recheck our YouTube webinar. So I hope you will get the answer for this 1.1 million to 1.5 million. The webinar will be uploaded on YouTube shortly. I think last question, and then we'll move with Talha. When there is a finance lease agreement of 5 years for a company S, before 5 years, the company P acquires the company S and valued the net asset of the company and the lease asset showing an interest in the market, how it should be treated in the consolidated SOFP. Wow, that's a technical one.
Let me read
Mr.
it again.
Ahmad.
When there's a finance lease agreement of 5 years of company S before 5 year, the company P acquires the company S and value net asset of the company and the lease asset showing an increase in the market, how it should be treated in the consolidation. Like any valuation in the consolidated entity, it would trade exactly the same. So again, I don't think that acquiring would have any impact on the lease accounting, except that the accounting policy disclosures and accounting policy would be in line with the acquiring company. So from the lease liability side, because the lease payment would be expect lease payment would be the same, and so the discount rate would be the same, and therefore the lease liability would not have an impact. If you are revaluing an asset, that asset would be revalued in the normal manner.
Perfect. Thank you, Imad. And now we'll move towards Talha. Imad, could you please continue sharing the screen?
Sure.
That'll be helpful. So Talha will be speaking a bit on the automation and real life challenges that we face while we are incorporating IFRS 16 in our systems. As I initially briefed who Talha is, Talha's background is basically he comes from a chartered accountancy background, and he has implemented various ERPs. So that's why we say him as a perfect combo, who not only understand the accounting side, but also translate the same into the systems. So over to you, Talha. All the best.
Thank you so much, Khushboo, for such a generous introduction as well. Having said so, I have to say, like, Ahmad's in-depth knowledge, skill, and experience in IFRS, training, and also the webinar is, I'm sure, like, it's something which we all will be learning. It's something which I hear from my clients as well from day to day, but I'm sure every other participant has had a very, very good time in terms of understanding how it works, basically. Now, the way we work are, just to give you an oversight, like what exactly is ERP transformation or digital transformation and the automation for the companies, our clients. Basically, we specialized in implementing accounting solutions, depending on different ERPs, where we try to automate the whole accounting process, which is in compliance with, IFRS or any local regulation, taxation rules, or anything in that part in terms of management policies as well. Basically, what we try to propagate is to change the way culture is done in terms of different company. Let's suppose we talk about the IFRS 16. I just highlighted some of the key issues when I see my clients maintaining Excel sheets in terms of schedules, new acquisition of properties or anything on that part. What exactly is the problem with all that Excel sheet? So step one is like, I'm sure like last 40 minutes, we still did not cover every aspect of IFRS 16, and it depends on industry, nature of your business, and size of your organization as well. Now, to keep everything on an Excel sheet with a lot of complexities in terms of how you want to treat your to have your accounting treatment for your lease liabilities, right of use assets, interest expense, and depreciation. That's really, really complex in terms of maintaining an Excel sheet. One fundamental issue with maintaining an Excel sheet is like someone who was managing the Excel sheet may know more than someone who's going to take over the job down the line, So the Excel sheet handover is never very smooth because someone else comes in, may not understand everything what being done on Excel sheet. So I have seen in a lot of companies, like someone left, he gave me this Excel sheet, was working fine, but no more. So that's one aspect which we see in terms of why maintaining Excel sheets are not exactly up to the mark. Second thing is like formula errors. Like we all, through our accounting, careers, we have seen anything goes wrong in Excel sheet, trace back is again a process to go back and check it out and make sure everything is in lines as well. Third thing is like data management. So you're processing a transaction in any of your accounting software, whatever you're using it. But again, on the flip side, you still have to go back and, input every information in your Excel sheet, update your lease terms, interest rate, each and every aspect you have to upload separately on an Excel sheet and manage it as well. Third thing, which is very, very important, is the modification and reassessments. Okay. Now, once you do a modification in Excel sheet, you basically drop an email, take a screenshot, send to your manager, supervisor. Maybe you yourself are doing all of it, so you don't need to do any of these things. And you lose track when exactly I did the modification, what was the effect, what was the previous version for it, So that again is a complexity which we see different organizations go through, where IFRS 16 is implemented and they don't have that sort of mechanism for, segregation of duties or even audit trails as well. Third thing is the compliance and disclosure requirements. A lot of us prepare the disclosures, and compliance directly on Excel sheet, like, okay, I'll input the numbers, I'll get the information, which seems easier at a very small scale or medium scale. But once you are managing over 100, 200 simplified lease liability assets or right of use assets, that becomes a way complex to compile everything on that part. These are some of the challenges which I have seen in last 15 years of implementing ERPs. These start from very basic organizations to even MNCs as well. IFRS 16 for say is a very specialized tool which companies require in terms of automating the whole process. So I'll just not going to dig a lot deep into it. I'm sure you all were very interested in knowing how the IFRS 16 treatment works, which Imad has explained earlier. I'll just take you through the simplified process. Imad, if you can take us to the next. Yeah. So how does it work basically? How do we implement basically IFRS 16 which is in compliance with the standards, and how do we do that? Let's understand a bit small practical example. Let's suppose you are going to rent a building for your office or for your, let's say, a retail outlet, a unit, whatever that is, and you're gonna go for a longer term lease term on that, and it falls under the let's say finance lease, considering all the bullet points which you need to consider before declaring it as a finance lease, not the operating lease. So the whole process starts from the very first thing. When you enter the very first basic bill and you book it under the lease liability assets and say like, okay, I have this long-term lease and I'm going to book it up. The way automation works is like step one for us to ensure you're in compliance. We define what defines operating lease and what defines the finance lease on that part. Okay, that's the step one for us to understand. And this is triggered on the back end based on how we define the different terms and conditions which are met at the time of uploading such document into the ERP. So that stands with the compliance with the standards, compliance with the how the IFRS 16 explained the whole process. Second step is once you post the bill, what should system do? System will understand, let's suppose this is based on the input, this is the, let's say finance lease, and these are the points we need to consider. It takes you to a bit automatic, let's say asset model, which drives the whole mechanism for you, picks the amount, picks the tenure of your contract, which you have submitted at the initial stage, and then also the interest rate, which you need to have, to create the interest rate calculation throughout the period as well. This is called automation. So it does not stop right over here. It tells you in the draft entry state, like these are the entries I'm going to post at these certain periods of your schedule, lease term as well. So one thing is like in terms of monthly closing, you don't need to go back and push the entries from your Excel sheets into your ERP. What system will do will always tell you the schedule for end of each month. You can open up X number of your, let's say, assets, and you can see basically what system is going to post end of each month, whatever the date is. And let's suppose at the start of the month as well, depending on your period. This is called automation, and the automation calculation and posting as well. Now, one key aspect which we need to understand is the data validation. Now, each time we do an input in any ERP, we basically support it through supported documentations, necessary approvals from the management, and we upload every document over there as well, which we don't usually do in Excel sheet. We just refer to our, let's say, folder XYZ, which I kept in my computer, desktop or my laptop, which is just a reference unit for us. But here in any of the ERPs, what we do is like you upload the supporting documents right up there as well. That is exactly there. Now, in the previous slide, we talked about how if you do the modification arm, how you keep a trail on it. So it works in two ways. So you can have a role-based access as well, and then also the audit trails as well. So what is role-based access? Only one certain level of accountant can only upload certain information or create an asset within the system, but he cannot further process to authorize it. It has to go to someone else who will take it up, approve, go through one more check. Everything is all good in terms of information, and then process it from there. It keeps track of the whole process, tracks not just who uploaded and created that, the document. Secondly, who approved it as well. And if there's any change down the line, so it covers your audit trails directly from the system as well. Then, of course, like once we talk about the reporting side, which you again, most of the clients which I have seen who are not using dedicated, let's say, leasing softwares, as of now, they will depend totally on the Excel sheet and the accuracy of it. Okay, so these are some of the scenarios or the point steps which we consider when we do the implementation, automation as well. And of course, like end of the day, it's all about support and training which we provide, which based on any software which you have, you can go up and take it up from either implementation team. But again, that's very, very fundamental to understand how the whole process works and how it will help you to streamline your accounting processes. I'm not going to take a lot of your time. I mean, I think we were all focused on the treatment of IFRS 16, which Imad has explained previously, but I'll be happy to take up any questions, just related with the automation, or if you have anything on that part.
I think we just have one question at the moment. So basically, he's asking that do we provide any service for transitioning to modern lease management solution from the legacy system? If yes, is there any specific industry or solution we work with? Do we have any solution partner or panel? I think, Saad, for this, we can discuss separately because we don't want to put a
Yeah.
name to any partner online. But if you have any specific question regarding any solution that we do provide, yes, we do provide. We have partnership with certain ERPs, I would say. And if there is anything we can help you with, I think you can reach out to me or Talha, and definitely we can bring up a good solution for you. Apart from that, Talha, would you want to add something to it?
No, I think this is again very specific to industry requirements based on what sort of legacy system you're using as well. So I mean, there are certain factors we need to consider before we can pull up anything like what could be the solution for you. But of course, we can look into it.
Exactly, there are different industries, there are different solutions available. So we can discuss it off the record, which one suits you. And we have been implementing various on various clients. So we definitely will find a solution for you, not a problem.
Yeah.
I think we are done. Last question, this is for you, Imad. Imad, I can't see you,
Can you hear me?
but your video is gone.
Yeah,
How
my
can
camera's charging just ended.
happens, yeah, without any technical issues?
Yeah.
Okay, I think it's a one question regarding the implicit rate. So if the entity's borrowing rate changes every year, do we need to review and adjust the implicit rate every year in the schedule?
Not at all. Not at all. And the both the interest rate implicit in the lease and both the incremental borrowing rate of interest, they are determined only at the inception of the lease, and they are not revised until a modification happens. So when we talked about having a new updated interest rate, we were talking about the case of a modification. That's where a new contract has arrived. Basically, the contract has changed, and therefore we now have to update the interest rate as well.
I think we've already answered this question. While performing the modification, do we revise the rate of interest? I think
Yeah.
we already respond.
Yeah, at
Yes.
each modification, we revise the rate of interest.
And one question for Talha. regarding the ERPs we were talking about. So someone would like to know whether these ERPs are designed solely for IFRS 16 and will it be integrated with the core system?
See, the point is like these are called modules, which are dedicatedly developed for IFRS 16, but can be integrated with your ERP depending on the integration allowability in your current system.
I hope we have responded you. Imad has shared in the chat box the link for our upcoming training on IFRS 9. So anyone would like to register and join, please feel free to join. I think we are good to go. We have already taken a lot of time, but I think it was a interactive session and hope it helped all of you. And someone is also requesting to arrange another session for the lessor perspective. Yes, I think we should be, and we have plans to come up with more practical solutions and examples. And based on our experience on different clients, since we have been advising various clients, we have experience of different industries. Every other day, we come up with a new scenario and we come up with a solution as well. So we'll hopefully coming up with new and different technical solutions for you all. So stay tuned with us. And we had a wonderful time. And thank you, gentlemen. And hope to see you soon. And Imad and Talha, it was a very interactive session. And I thank on behalf of all the participants. And on behalf of the speakers, I thank all the participants who stayed tuned with us for almost 1.5 hours. Again, this will be uploaded on the YouTube channel of athGADLANG. If you need any assistance, you can write to me, to Imad, and to Talha. And on our LinkedIn profiles, you can find us on LinkedIn very easily. You can text us anytime. And let's see how we can continue this session. And we'll plan something more for you guys. Thank you very much and hope to see you soon.
Thank you,
Bye-bye.
everyone.
Thank
Thank
you.
you. Thank you.